Now let's talk about those taxes and when they apply and at what rate. Let's start with capital gains tax.
Okay, so let's remember that CGT is only paid when you realise the gain. So if you imagine you've invested £10,000 and over the year you've done really well on the stock market and you've got a 10% return, so your pot then is £11,000 sitting there. You don't pay capital gains on the entire £11,000. You only pay capital gains on that £1,000 of gain that you earned. Now I say could pay tax on it because you do have a capital gains tax allowance each year. At the moment, for the current tax year 22 to 23, that's £12,300, very specific amount. So if you haven't used up all your allowance, you won't have any capital gains tax to pay. That's not an allowance for each individual investment you have, that's an allowance for your total investments that you hold. So let's say you've had a really profitable year on the stock market, you've done really well and you do have some capital gains tax to pay because you've gone over your allowance. Your CGT rate that you pay is then linked to what you pay in income tax. If you're a basic rate taxpayer, then you'll pay 10% CGT, and if you're a high rate taxpayer, you'll pay 20% CGT.
Great, fantastic explanation of CGT. Let's talk about the rates that apply on dividend tax.
Yeah, of course. You can earn up to £2,000 a year in dividends tax-free, which is the good news. There's another allowance for you that, but after that it's taxed again, and it's also taxed in line with your income tax. Now, I've written these figures down because they're very, very specific. So if you're a basic rate taxpayer, you pay dividend tax at 8.75%. Right. If you're a high rate taxpayer, you pay it at 33.75%. And if you're an additional rate taxpayer who's earning £150,000 a year or more, you will pay 39.35% in dividend tax each year. Now, some people choose not to take out their dividends as income, which you can do. They keep them reinvested in their portfolio, building their pot of money up. Now, just because you do that, it doesn't mean you won't get taxed. Unfortunately, you will still get taxed on those dividends, whether you keep them in your portfolio or not. So it's just something to bear in mind.
Yeah, got it. Okay, well, let's move on to the final one. That's stamp duty reserve tax. What are the rates that apply here?
So when it comes to stamp duty, everybody pays the same rate. It's a 0.5% flat rate. It's a sales tax basically on UK listed stocks. And it's not a huge sum. It's paid at purchase and it's usually tied up in your transaction costs. So you never actually see that tax explicitly, as it were. But what you have to remember is if you're doing lots and lots of large trades, you're paying that tax over and over again. So that can really add up and it can add to the cost of trading. The other thing is you do pay that tax if you're investing through a tax-free wrapper as well.
Yeah, of course, this tax applies on shares bought inside a tax-free wrapper as well. There's a lot to consider there and potential for those taxes to add up. So how should investors record those taxes and when and how should they pay them?
So if you're making gains outside of a tax-free wrapper, HMRC is going to want to know about it because they're going to want their cut of your money. That's 100% for sure. But you don't need to be a tax whiz to work out what you need to pay to HMRC. Basically, your investment platform should be providing you, probably will provide you, with a tax summary or certificate each year that will tell you how much tax it is owing and how much tax is due to HMRC, which is great. If you haven't registered with HMRC before because you haven't paid a tax return before, you will need to register online. This can take a few weeks, so do not leave it till the end of the tax year and try and do it all in one go because you'll probably miss the tax deadline. And your online return has to be filed by the 31st of January in the tax year after the gains have been made.